Today, we're getting into the practical side. Where do you actually open an account? When should you start? How much do you need? And what are the costs and tax considerations that you need to understand before you begin? But before we get into it, a quick note. If you're new here, my name is Melanie Davies. I'm a licensed independent financial advisor. You can find more out about me on the Financial Advisors Register, which is linked in the description box below. Everything I share here on this channel is general in nature. Everyone's circumstances are different, and what's right for one person might not be right for another. My financial services guide is also available to download from the description box below. Okay, let's get into it. So where do you actually go to buy ETFs or managed funds in Australia? Well, in Australia, there are a few different ways to invest, and the right one depends upon your situation. Today, we're just going to focus on the three most common starting points for people who are new to investing outside of their super fund. The first one is going to see a broker or through an online share trading platform. Now, this one gives you direct access to the ASX to buy and sell ETFs and shares yourself. You're in control of every transaction, so you get to decide what to buy, when to buy it, and how much you pay. Brokers can give you advice as well, so it's a great idea to go into the office or open an account online with them and reach out and they'll explain the process. Brokerage is a bit higher if you go direct to a broker because of this, and rightly so, you're getting a really personal experience. Then there's the online share trading platforms. Now, these ones vary quite a lot in cost and features and ease of use. There's loads of those online to choose from, and some of them are with the major Australian banks. So when you log into your internet banking, you'll be able to see your share trading as well. Now, a lot of people think they're really convenient because they already bank with them, so everything sits in the one login. Others prefer a standalone platform built specifically for investing, which can sometimes offer lower fees and more features. Now, take note of the brokerage you're paying, especially with starting with smaller amounts. The second one is a managed investment platform. Now, these are built for regular automated investing and typically offer access to managed funds and ETFs all in one place. They usually come with lower brokerage or no brokerage and lower minimum investment amounts too. And these ones are good because you can set up automatic contributions, so investing becomes a bit more of a habit rather than a job that you have to remember to do. And some of these platforms allow you to start with as little as $200. Now, the third one, probably not the most popular, but it's going direct to the fund manager to buy a managed fund. Some people or investors choose to bypass a platform entirely and invest directly through a fund manager's own website. So they might use a platform for their main portfolio, but then invest off platform as the investment that they want to buy is only available off platform. And usually you can apply online and then make contact with them directly if you want to make additional contributions or set up a regular savings plan. It's worth knowing this option exists, although it tends to suit more experienced investors. The process is a little more manual too than using a platform, and fees can be a little bit higher. This is a more complicated process, and you should probably stick to either option 1 or option 2 to keep things easier. Now, which one of these suits you comes down to your starting balance and how hands-on you want to be, and what features matter most to you. All three are legitimate pathways to investing. Okay, things to think about when comparing your options. You need to look at the fees per trade or transaction, the minimum investment amounts, and whether they support the investments that you want to access. Also, how easy is the platform or process to use? And do they offer automated contributions and regular investing? So if you head to the description box below, I've linked to the Money Smart website. So that's ASIC's free government resource for Australian investors, where you can read more about the options and find some guidance on what to look for when you start out investing. Now, be careful about relying solely on the platform's own marketing. Most platforms have a pretty straightforward online application. And don't forget, you're always going to need your tax file number, proof of identity, and a linked bank account. So when do you get started? And the honest answer is as soon as you're ready to, as soon as you're in a position to, and that decision is pretty simple to reach. You don't need to wait until you've got a large lump sum, and you don't need to wait for the right time in the market. Nobody, not fund managers, not economists, no one, not anyone can constantly predict the best day to buy. What we do know is that the longer your money is invested, the more time compound interest has to work. So before you start investing, though, it's worth making sure a few of the basic things have been taken care of. So the first one you need to make sure is out of the way is your emergency fund. Roughly 3 to 6 months of living expenses is sitting in an accessible high interest earning savings account. That's your financial buffer. So if something unexpected happens, you're not forced to sell your investment at the wrong time. You need to have your high interest debt sorted too. So if you're carrying some credit card debt or a personal loan, all at high interest rates, those interest costs will typically outpace any of your investment returns. So addressing those early usually makes more financial sense. Plus your cash flow, having a sense of your income and expenses early on is a good thing to get out of the way and have those three things ticked off. So think carefully about your situation and what other obligations you need to meet. And have you included those in your cash flow? Make sure you've thought about other big expenditure items too that might be coming up and that you've put separate money aside for those. Now, once those key foundations are in place and you've addressed all your commitments, you're in a much stronger position to invest with confidence. Now, 3 to 6 months of your cash flow, I know it sounds a lot, but try and get at least 3 months sitting in a high interest earning bank account. So how much do you start off with? Well, you don't need a large amount to begin. Small regular contributions into a diversified low cost fund build real wealth over time. So start with what you feel most comfortable with, increase it when you can, but just keep going. Okay, let's tick off the costs to understand. Costs reduce returns. So this is an area that a lot of beginner content glosses over, and it matters. So let's go over it so there's no big surprises. The costs you pay depend upon which pathway you've chosen, and they work quite differently. So if you're investing into ETFs, every time you buy or sell an ETF through a broker or a platform, you'll pay a brokerage fee. This varies platform to platform. It might be a flat fee per trade or it might be a percentage of the transaction. So why does this matter? Well, if you're investing a small amount regularly, let's say $200 a month, and your brokerage fee is $10 a trade, well, that's around 5% of your investment before you've even started. And that's significant. So a few ways to manage this are invest less frequently, but in larger amounts to reduce the number of trades that you pay for. Compare the platform specifically on the fee structure if you plan to invest regularly in smaller amounts, and consider whether you'll be better off with a managed fund instead. Now, you might also hear the term bid-ask spread when it comes to ETFs. This is simply the small difference between the price the buyer is willing to pay and the price a seller is willing to accept in a given moment. And it's a normal part of how markets work, rather than a fee that you're charged directly. For widely traded ETFs, it's typically very small, but it's worth knowing the term for when you come across it. Okay, another tip is avoid buying or selling ETFs at the start or end of the trading day. So in those opening and closing windows, trading volumes can be lower. Market makers might not yet be fully active, and ETF prices might not accurately reflect the true value of the underlying investments. So that means that you could end up paying more than what you should when you're buying or receive less than what you should be when you're selling. And away from the open and close, the spreads are generally tighter and prices are more reliable. It's just a simple habit that can make a small, but it does make a meaningful difference over time. And if you're investing in a managed fund, there's no brokerage fee with managed funds because you're transacting directly with the fund manager. Instead, the cost you pay here, or the cost you need to understand, is the buy-sell spread. Here's how that works. Managed funds are priced by the fund manager using what's called e-unit price, and essentially the value of your share or fund on any given day. When you invest, you buy in at the buy price, and when you withdraw, you exit at the sell price. The difference between these two prices is called the buy-sell spread, and this price exists to cover the fund manager's transaction costs when they buy or sell the underlying assets on your behalf. Okay, let's chat through MERs. An MER is a managed expense ratio, and both ETFs and managed funds charge an ongoing annual MER. This is deducted from the fund automatically, and it reflects the cost of running the fund. So for passive index options, this is typically lower than active options. For active managed funds, this can be significantly higher, sometimes like 1% or more annually. Let's go through a few of the key tax considerations here. Now, this is general information only. For anything relating to your personal tax situation, make sure you speak to your accountant or a registered tax agent. So let's talk through quickly CGT, which is capital gains tax. So when you sell an investment for more than what you pay for it, the profit is generally subject to CGT. In Australia, under the current rules, if you hold an investment for more than 12 months before selling, you might be eligible for the 50% CGT discount, meaning only half of your capital gain is included in your taxable income. It's one of the reasons long-term investing has been really tax effective in Australia. Now, it's worth knowing that in the 2026 federal budget, there's been proposed significant changes to how CGT works from the 1st of July 2027. The details are still working their way through Parliament, so nothing is set in stone yet. But in simple terms, the proposed changes would replace the 50% discount system with a system that adjusts your purchase price for inflation. And it also introduces a minimum 30% tax rate on capital gains. So instead of automatically halving your gain, you'd only be taxed on the growth that's going to be above inflation. For some investors, that could mean paying more tax when they sell, but for others, depending upon their situation, the impact may be different. What that means for you as a beginner investor is that this is a space to watch. And it's another good reason why having a good accountant in your corner matters, or speak to a registered tax agent. For most beginners, a simple, diversified, low-cost approach, investing regularly into a broad market index fund, is a clear and a sensible starting point. Keep costs low, stay consistent, don't try and time the market, don't buy direct shares, and before you start, make sure your emergency fund is in place, your high interest debt is paid, and your cash flow is clear. And when it comes to tax, get familiar with CGT franking credits, the importance of your TFN, and the changes that might be coming with the budget. So the most important step is just starting, because small, consistent action over time makes a really big difference, more than what you think. Now, if you'd like personalised guidance on any of this and how it applies to your specific situation, your goals and your timeline, that's exactly what a financial advisor is here to do. So if you're looking for an advisor, I'd recommend checking out the CIFA website. So that's the Certified Independent Financial Advisors Association. It's a great place to start when you're trying to find an advisor who has chosen to operate with complete independence from financial institutions and products. I'm a member myself, and you can search for someone in your area on the CIFA website, and I've linked that below. Okay, so if this was helpful, please subscribe. I post regularly here to help everyday Australians feel more comfortable and more in control of their money. And there's a lot more coming on investing and building wealth at every life stage. And subscribing helps me reach more people in your age group. So drop any questions that you've got in the comments section below, because I'll definitely read it. And of course, everything mentioned today, including my financial services guide and my listing on the Financial Advisors Register, is linked in the description box below. Thanks so much for watching. I'll look forward to seeing you next time.